Nokia stock is currently trading at a live price of $13.98 during this intraday session, representing a downswing of 5.66% on the New York Stock Exchange. While casual observers tracking ticker movements on a basic retail app might view this single-day pullback as a typical cooling-off period for a legacy tech meme, the underlying narrative reveals a massive structural shift that most investors are completely missing. The headline story on social media or standard investing sites is that the old telecom hardware giant is merely experiencing some routine profit-taking after a hot streak. However, the unexpected reality driving institutional positioning right now is a heavy multi-million-dollar domestic manufacturing bet that closed just 24 hours ago. Nokia just announced a major multi-million-dollar expansion of its advanced test and packaging operations in Allentown, Pennsylvania, specifically designed to multiply its production capacity for photonic chips by up to 10 times. This is not about building cell towers or selling legacy routing hardware. This is a deliberate, massive play to control the hardware bottleneck for next-generation data traffic. By leveraging federal incentives and state partnerships, they are locking down domestic supply lines for the exact optical components that prevent data centers from melting down under intense data workloads. When you look past the immediate single-day price tip, the tension between what retail investors expect and what the institutional desks are executing becomes glaringly obvious. The common expectation among market participants who track the sector on a standard individual brokerage account is that Nokia is a slow, cyclical utility supplier bound to the capital expenditure whims of telecom carriers. People remember the company for its historical hardware struggles or its steady, unexciting dividend payouts. The general consensus assumes that once a telecom build-out ends, the revenue dried up, leaving the equity to drift sideways. But that perspective completely ignores how the computing landscape has fundamentally mutated. If you log into your choice of modern platforms, whether that is checking positions on the Robinhood app or studying long-term trends through Fidelity Investments, you will find that the highest trading volumes are no longer tracking traditional mobile cell towers. The contrarian take that smart money is paying attention to is that Nokia has positioned itself as the physical highway system for artificial intelligence infrastructure. Wall Street giants like JP Morgan recently threw a massive wrench into the bear thesis by doubling their price targets on Nokia stock, pushing expectations way past the current trading range, up to $21 per share. The institutional logic is clean. The massive processing units made by names like NVIDIA stock require an absolute mountain of data to transfer instantly between servers, and traditional copper cabling cannot handle that volume without massive latency. The reality of the modern tech landscape is that optical networking, high-capacity fiber, and specialized switching systems are the absolute gatekeepers of data center efficiency. Let us look closely at how this reality is showing up in the recent daily swings and macro pressures affecting the technology equipment sector. Just last week, Nokia stock experienced a massive surge, climbing over 10% in a multi-day rally as traders digested a massive wave of analyst upgrades and internal sales data. The core driver was an official disclosure that the company booked over 1 billion euros in new cloud and specialized data infrastructure orders in its opening quarter alone. If you study the institutional order flow on an interactive brokers platform, you can see that the accumulation patterns began accelerating heavily after major firms started realizing that Western markets are facing a massive supply crunch. Geopolitical shifts and strict regulatory boundaries have effectively locked out major Chinese hardware competitors from Western data centers, leaving a massive vacuum. This leaves the entire enterprise market relying almost entirely on a select few players, primarily Nokia and its direct rival Ciena. That regulatory moat is a massive catalyst that typical retail investing sites rarely quantify accurately. It means Nokia is not just competing on price or product features. They have a structural, state-supported advantage in the geographic regions spending the most capital on cloud expansion. Yet, despite this massive tailwind, we are seeing today's 5.66% intraday drop to $13.98. Why is the market pulling back so sharply right now? This is where the psychology of expectation versus reality plays out in the short term. Because Nokia stock has put up an astonishing rally over the past several months, gaining well over 70% since the start of the year, it has become highly sensitive to any broader macro cooling. When retail traders using simple apps like Robinhood stock trading see a massive run, they get anxious. The moment the broader tech sector shows a hint of fatigue, profit-taking triggers instantly across retail platforms. Furthermore, the options market has shown a clustering of open interest around the current price boundaries, meaning market makers are actively hedging their positions, which amplifies these short-term downward swings. For an investor executing self-investing strategies, distinguishing between an institutional thesis shift and structural profit-taking ahead of the July 2nd order earnings report is the difference between panic selling and calculated accumulation. The trading volume today shows that while retail hands are washing out, the institutional blocks are absorbing the float, recognizing that a tenfold capacity expansion in advanced photonic packaging is an indicator of massive multi-year demand visibility.
To appreciate how wild this current transition is, we have to look at what this business model actually looks like when you peel back the layers. For decades, Nokia lived and died by its mobile networks division, designing and selling the base stations, antennas, and radio access networks that global carriers use to broadcast cellular signals. That business is highly cyclical and capital-intensive, requiring massive research budgets with long payoff periods. But under recent leadership adjustments, the company engineered a quiet internal migration toward network infrastructure, which handles IP routing, optical networks, and deep subsea fiber cable systems. Their business model now relies heavily on selling proprietary software stacks tied directly to high-performance silicon. They design the specialized chips that route data packets at light speed using lasers rather than electricity. This optical transport segment is exactly where the massive spending is happening. When a major cloud provider builds a massive server farm, they need to connect thousands of processing units together. If those connections lag by even a microsecond, the entire computing cluster stalls. Nokia sells the exact optical transceivers and switches that prevent that bottleneck. They are essentially selling the plumbing for the modern cloud. And because their systems are deeply integrated with proprietary security protocols, the switching costs for their corporate clients are incredibly high. Think about how this contrasts with other tech giants that dominate the retail headlines. When people look for technology investments through the lens of individual brokerage accounts, they naturally gravitate toward consumer-facing software or hot semiconductor names. If you look at options inside a standard individual brokerage or review popular allocations within Schwab Intelligent Portfolios, the focus is almost always on the high-profile software layer. People understand apps, consumer devices, and raw processors, but very few retail investors consider the underlying physical network that makes those systems viable. It's an extraordinary blind spot. A high-end graphic processor is completely useless if it cannot receive data fast enough to keep its core saturated. That's the exact friction point Nokia is solving. It's why major semiconductor developers are actively partnered with them, including a notable $1 billion structural collaboration focused on combining wireless infrastructure with accelerated edge computing workloads. They are changing the architecture of how data is processed, moving from a model where information is bounced back and forth sequentially to an inline system where data is processed directly as it flies through the optical network. Let's pause here for a quick sanity check because I want to hear your perspective on this structural shift. Comment below how many shares of Nokia stock you currently hold or if you're planning to add it to your portfolio during this current pullback. It's always fascinating to see whether retail traders are buying these structural tech tips or if they prefer sticking to more mainstream software names. When you look back at older earnings reports from a year or two ago, the numbers were admittedly sluggish. The company was dealing with the tail end of a slow global rollout for mobile network upgrades, and their margins were squeezed by high component costs and supply chain friction. Bears often point to those past reports to argue that the company cannot sustain a high valuation multiple, noting that legacy segments like fixed networks still see double-digit revenue declines as old copper lines are phased out. That's a fair historical critique, but it completely misses the forward-looking product mix transition. In their latest financial disclosures, the gross margins for the optical and cloud infrastructure segments came in vastly higher than their legacy mobile hardware business. The operating profit surged over 54% year over year to 281 million euros in their initial quarterly print, driven almost entirely by a 49% explosion in sales specifically to cloud and AI infrastructure buyers. This means that as the legacy low-margin disperse shrinks and the high-margin optical infrastructure business expands, the company's overall margin profile is undergoing a massive upward re-rating. This brings us to the forward outlook and the potential catalyst that will determine whether reality will continue to beat market expectations over the next 12 to 18 months. The most immediate milestone on the horizon is the upcoming second quarter and half-year financial release scheduled for late July. This report will be highly scrutinized because it will offer the first clean look at whether that massive €1 billion order book from earlier in the year is successfully converting into recognized revenue and cash flow. If the company shows that execution is matching their upgraded full-year operating profit guidance of 2 to 2.5 billion euros, it will validate the aggressive price targets set by institutional desks. Conversely, any signs of deployment delays or supply chain constraints in their newly expanded Pennsylvania facility could cause short-term disappointment, giving the bears room to argue that the infrastructure build-out is taking longer to materialize than anticipated. Beyond individual earnings dates, the broader macro environment presents both severe risks and significant opportunities. On the risk side, corporate capital expenditure budgets are notorious for sudden shifts. If global cloud spend cools off or if hyperscalers decide to pause their infrastructure expansion to digest their current capacity, hardware suppliers like Nokia will feel the chill immediately. There is also the reality of intense execution risk. Expanding manufacturing footprints tenfold requires flawless operational management, and any labor shortages or engineering bottlenecks could eat into those projected $500 million regional economic impacts. On the opportunity side, however, Nokia is sitting on a massive psychological moat. Their new agenty network frameworks designed to automate complex IP routing using advanced software models are slated for commercial deployment later this year. This moves them further up the software value chain, allowing them to capture recurring subscription revenues rather than relying solely on one-time hardware sales. For anyone managing their own investments through a self-investing framework or utilizing sophisticated tools like interactive brokers trading platforms, this stock represents a classic study in market mispricing driven by historical bias. The market is treating a company with a fundamentally transformed product mix as if it was still the legacy corporation from a decade ago. They are looking at the 5.66% intraday drop to $13.98 and applying old formulas, ignoring the reality that the physical constraints of modern data centers are forcing tech giants to buy every piece of high-performance optical gear they can get their hands on. The expectation was a dying telecom supplier, The reality is a vital structural piece of global data infrastructure. Whether you manage your capital through traditional Fidelity brokerage accounts, execute rapid trades via the Robinhood app, or maintain a long-term position in a diversified portfolio, tracking how this structural gap closes over the coming quarters will tell you everything you need to know about where the real value is being created in this technology cycle. The short-term volatility is simply the noise of the market trying to reconcile its old memories with a completely rewritten operational reality. Disclaimer. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Bye. Don't forget to like, comment, and share this video to support the channel.